Hi, I'm Toby.
And I'm Nick.
And welcome to the Pure Property Podcast with Track Capital, where we talk about all things property and property investment. The aim of the podcast is to give you our industry insight and knowledge in bite-sized chunks to help investors to invest intelligently. And this week's episode, we're going to be going over frequently asked questions. So me and Nick have been putting our heads together and thinking, what questions do we get asked a lot, especially at the moment? Can we put that into an episode and put it out there? So yeah, it's a good go-to for investors, and they might be questions that you may have or listeners may have, and they can have a listen, hear our responses, hear our take on the questions, and go from there.
Perfect. So before we dive into the episode, a lot of our more avid listeners will realise that we haven't been around for a few weeks now. We've been exceptionally busy. So Toby, I don't know if you want to provide a bit of an update your side very briefly.
My side is, been very busy, especially the last few weeks anyway. So I've now got a newborn baby boy. I've been crazy enough to have a third child.
Couldn't resist.
couldn't. Hence the hairline getting further and further back. So yeah, I had to drop off the radar for a bit just while he got settled in with his two elder sisters and his mum, of course. So yeah, just been busy doing that and still try and stay on top of work and the business, property market, and Track Capital in general. But it's all good. He's all settled in now. I'm back to, I'd say, some sort of normality. Getting back into the swing of things, and yeah, just trying to take one day at a time. And Nick, I suppose your background probably gives a bit of an indication as to why you've been a bit quiet. I mean, because that clearly isn't, I don't know, London or Grimsby or anywhere like that. It looks sunny and it looks a lot nicer than where I currently am at the moment.
Yeah, I'm not sure if you can get the full view there, but yeah, so as well as Toby obviously being busy, and myself being the other director of the company, I've now relocated to Dubai for a number of reasons, mostly personal, but also some commercial opportunities we might be looking at here as well. So yeah, between me and Toby, obviously spending a bit of time away from the business, our content rate has slowed down a bit, but luckily our sales have been absolutely exceptional. A really strong team effort. It's been the best performing month we've ever had in the company's history. So I think, we're both obviously very, very pleased about that. But without, blowing our trumpets too much, Toby, what was your sort of insight for August? How you feel it went, what we did well, etc.?
Yeah, I mean, we tend to find in general in the property market that August tends to be usually a bit of a quieter, slower month, just because people are on holiday, kids are off school as well. There's usually a lot going in August, or people then getting ready to get back into work and back into the swing of things if they've been on holiday in September. So you tend to find it's a steady, quietish month, and then it really picks up September onwards. But yeah, it started sort of all guns blazing at the beginning of the month. Then it kind of settled like we expected it to, and we were like, okay, this is a normal August. And then literally, I think it was the last week, it absolutely just went crazy. And in general, yeah, it was just a very sort of active, buoyant month. But I think when you look at the market in general, it was maybe a bit naive to think it was going to be a slower month, just with the sort of the bottleneck of demand that's been building up throughout the year, and just in general lack of supply. It was bound to happen. But yeah, it's good, it's positive, and definitely can't complain on that side of things.
Yeah, definitely. I think a lot of people obviously didn't, they weren't away on their summer holidays as much as they probably normally would be for obvious reasons. So yeah, obviously really happy. Repeat investors, new business. We've got September off to a great month as a great start as well. So yeah, all good on our side. So today we'll do a bit more, as Toby said, of the Q&A / frequently asked questions side of things, with the aim of letting our investors get some sort of valuable insight and some knowledge, things they might be thinking that's on their minds, what they're considering when they're looking at properties to invest in. So yeah, hopefully we'll run through a few of those. So Toby, I don't know if you want to pick a question first, and then maybe I can reel off a bit on that.
Yes. So I'll start off with one of the frequently asked questions. What can we go with? I'll tell you what. I know this is actually quite a good one that you actually like to cover. So we'll start with this. What are the benefits of off-plan investments? Now, this is obviously something that we do encounter quite a lot because when we speak to our investors, they don't always know a ton about off-plan investments, and they may be used to the standard secondary market. So, yeah, that's one of the questions that I'll start with for you, Nick.
Cool. And yeah, we'll try and keep these relatively quick fired. Obviously we can speak for potentially hours about these, but yeah, we'll try and give you the headlines. So firstly, with regards to investing off plan, the first thing that most people think about is the price. So you should, if you're buying from the right developer at the right time, get a strong discount on the development. Now, it's really important not to compare a new build off plan scheme to something that's on the secondary market in 10 months old 10 years old. You could go on Rightmove and you could find stock for a lot cheaper than you're going to see in a new build scheme, but you're comparing, a brand new car to an old car that's 10 years old. It's just not a fair comparable. So in most cases, one of the major benefits that investors will invest in off plan, or one of the main reasons, is because they're going to get that discounted price up front. And that should be for the ticket price and the price per square foot rate. So you've got to make sure what you're actually buying, what you're getting for your money, is worthwhile. Secondly, you get to pick out the most desirable units in the scheme. This is an absolutely huge one for me. With the amount of development that's happening across our major cities in the UK, Manchester, Liverpool, Birmingham, London, well, actually all of them, Leeds, Sheffield, they're all growing very, very aggressively. So there's a lot of development and potentially a lot of competition. So if you can buy into a scheme early and pick a unit with a USP, then that's going to really differentiate your product from someone else's and so I think I lost connection slightly there, but that will really differentiate your product from someone else's. So things like the balcony, both across the bedrooms and the living area if possible. Great views, larger than average size. If you can get a corner unit with a dual aspect view, that's great. If you're near the some people see it as a pro, some people see it as a con, but if you're near entrances or communal areas, there's a lot of things to think about of how you can make your specific apartment stand out in the crowd. So getting in early and picking out those desirable units is always a bonus. I think the other thing is the incentives and the packaged items that you can get with a developer. And I'll finish off on this one, Toby. You can maybe pitch in with any that you can think of. But getting a package and getting an incentive from a developer is a really strong bonus, and it can add up to actually quite a significant amount. Now, this will come in the form of free furniture packs, contributions to legal fees, contributions to stamp duty bills, fixed rental assurances for 1, 2, 3 years, depending on the type of property. But by the time you've negotiated with your broker, who should be good and doing it on your behalf, and you're dealing with a reputable developer who's open to some discussion, you can secure yourself a very, very good value investment package. But just to recap on those, then, so the discount, the ability to pick the unit, and then the ability to get a packaged investment offer where you're being incentivized to purchase off plan. Those are my three I'd probably mention.
Yeah, no, and I think touching on the price part there, and you mentioned about a new car, etc. Now, one of the benefits of a new build or a new car is one, you have the warranties. So if something does go wrong, you're covered, and also there's less likely chance for things to go wrong because they are new. So your maintenance and ongoing costs will tend to be a bit fairer on that basis. So what we find with the off plan is you're getting the benefits of a new build, which as investors do tend to like that side of things because it's shiny new. Less hassle and less maintenance issues and costs going forward. You're getting that aspect, but for a better price, because as we know, when you're buying a new build property, you're paying a premium for once it's complete. But when you're buying off plan, you're getting that discount. So you're getting best of both there. So you're getting a good price and you're getting the benefits of a new build property, which I think is very, very strong. I think the other thing that we will have to mention is just be careful that the price you're paying is not being perceived as discounted, because we've seen it in some poorer schemes or developments where they'll make out as if you're getting a discount as a buyer, but you're not. You're just paying the normal rate, or that they've put extra on top and they're just taking that off and pretending it's
Mm,
discount. So
definitely.
just be careful on that. So do be careful on that. Research and due diligence is key on that. And I think for me, the other thing that I'm speaking to investors about at the moment as a benefit of off plan, and this is market dependent, is the market that we find ourselves in at the moment, which is very buoyant, a very restricted flow of supply, as we can see happening and within the data. Um, what you're finding is if you're going out and viewing on a normal market, it's very, very busy. So, what is happening is, for example, if you have been out viewing, you may know this already, but you'll go on Rightmove, you'll find a flat. It's up for resale. So, the owner's living in it, selling it, or it might be an investor selling their property already rented out. It's already been lived in. On the open market, you'll try and book a viewing. One, you'll probably be lucky if it's a good location, good area, you'll be lucky to get a viewing in the first place. Two, if you do, you'll probably be going along to an open day or be up against a lot of people while viewing. So it'll be very, very busy. And then three, if you do actually like it and then you go to buy it or offer on it, you're then up against a whole pool of buyers, which are going to be first time buyers. They're going to be people moving up and down the ladder, and they're going to be investors. They're going to be cash purchasers, mortgage purchasers. There's going to be a vast array of people offering on that property, which then creates a bidding war, which then means if you do need to secure that property, you're going to be probably paying over the odds for that. So what we're seeing at the moment, and the feedback we're getting at the moment, is investors and buyers in general at the moment in this current climate, to get a property they want or desire in a good area, are having to pay over the odds. Now, why is that different when buying off plan or even new build to an extent? It's because you know exactly what you're paying. You're not turning up to an open day and having bidding wars and having to offer over the asking price. It's just you negotiating with the developer, and securing a price based on that. You can see the price per square foot. You can see the comparables. You know what you're paying. So in a market that we find ourselves in today, it is very valuable to have that, because you know you're not paying over the odds, and you know you're paying the correct value for a property, which when you're looking at return on investment, that is very key in the current climate we find ourselves. Would you agree?
Absolutely, and I think as well as the aspect of competition when you go and view a property, and people bidding and outbidding each other, I think what you'll find as well is you'll get a lot of people get emotionally tied, or they sell the idea of owning that property in their head before they've even bought it. So they're
Mm.
maybe making more of an emotional decision rather than a black and white, going by an email and a due diligence pack. They're a bit more tied in, a bit more emotionally invested in the property, which can cause an impact on the decisions and the final price that's paid. So yeah, hopefully that gives everyone a good overview of the benefits of buying off plan. And moving on to the next question, then we'll try and keep these ones a touch quicker. But with regards to locations, how would you advise an investor to ultimately pick a location to invest in, whether that's within a city or regional level? Do you want to give a bit of a take on that?
Yeah, so I'll try and do it sort of as briefly as possible. Now, you probably would do it in a bit more depth in this, but I think first of all, if you're not familiar with any areas, Google. Just Google is going to be a very good friend of yours. Google best areas to invest in the UK. You'll have hits. You will have to filter through some. Look on sites that are speaking about it. What are the familiar names being mentioned? You'll probably notice like Liverpool, Manchester. Again, just be careful, because sometimes you'll see some floated about where maybe aren't. Once you're then seeing a name mentioned quite a few times, maybe then pinpointing that. So if you're seeing Liverpool or Manchester or Birmingham floating around a lot, then start looking into that a bit more. So Google Birmingham, and then maybe start Googling popular areas in Birmingham. You'll probably find that you'll have city centres, you'll have little suburbs that are probably coming out well, and then start looking into those areas. And once you've looked at it, found an area which sounds good, maybe it's a city centre location, and you can see a lot of good feedback about it, or you're seeing a lot of businesses in the area, then you can start your process of looking at prices to make sure it's in your price range. So you might then go on Rightmove or Zoopla and type in Birmingham city centre, or type in a postcode of a city centre location, put a radius around it, and then start looking at prices. Once you found a price and you can see that it's within your price range and it looks fair, you then want to look at rental prices. Same process again for that area that you did for property prices, you do for rental prices. You can then get an idea on rental yield, obviously, which is going to be important for you as well. If yield is what you're focusing on, then you start to look at properties from there. So you're then, once you've found that aspect, you'll have a location, you'll have prices, rental prices, you'll have a good idea on what you'll be looking at, and then you can go out and start speaking to agents, or getting their point of view, or you might be doing that simultaneously to guide you along that process. But yeah, I would just be information absorbing, and using the internet as your friend to get as many brochures to download, looking at developments, looking at what you can get for your money, and trying to speak, if you can and have time, speak to local estate agents. What's the demand like? What's the appetite like? You can go as far as looking at sort of crime stats. Is there crime in the area? And if you're looking at a secondary market and maybe freehold houses, you then probably have to start narrowing down to streets, but that's where it gets very, very tricky. You want to look at the data, so use sites such as Home Track, where you can find out data about specific cities and locations. They have rental data and property price data as well. Yeah, that would be my starting point when you're looking at where to invest. Nick, what would you sort of throw in the hat there?
Firstly, yeah, I'd largely agree with that. I think the fundamental point that came across is research and due diligence. So when I'm speaking to investors, I always say to them, look, don't listen to what I'm ultimately saying or what other agents are saying. Don't just take their word for it. Get online and do some digging, do some research. Yes, you want to have an advisor who's trusted and will give you some expert advice, but ultimately it's down to you to make a sound investment decision. And there's so many resources online nowadays. There's just literally no excuse other than just general laziness. So yeah, I always tell people get online. I'll send you the links. I'll point you in the right direction. But yeah, do your research. And for me, it's just about going for the right location at the right time, to getting that key growth that's out there in these regional cities, capitalizing on that ultimately, not just going for what's down the road, not just going where your friend said. Look at the data and make a sound decision on that. And just lastly, a bit more of an insider look at things here, especially on the new build and off plan side. As a company, as many of our listeners will be aware, we speak to developers and we package up developments and ultimately market them and introduce investors to the scheme. But alongside that, obviously we keep an eye on what our competitors are doing, what's in the market, what comparables there are, what investors are also considering. So we know that if you're making an investment decision just based on a brochure, it's obviously heavily biased. They're going to put in everything positive, everything you want to hear and you want to see is going to be in that brochure. So what I'd say is go beyond what the agent gives you, be independent, and yeah, just do it an extra bit of due diligence to make sure you get those best locations. But hopefully that was enough on the location side of things.
Yeah, yeah.
So is it my go now? Shall I ask you a question?
No, I'll ask you a question. I think you asked me the
Okay.
question there. So, um, frequently asked question. Let's go with what makes a good mortgage broker, in your opinion, Nick?
Okay, cool. So yeah, again, looking at our business model, we work with multiple mortgage brokers who have access to different products on the market. So for me, reading off a couple of key points to look out for is firstly, um, your personal situation. Are they teed up to deal with that? So, are you an expat? Are you a non resident? Are you buying in a limited company? Do you have properties under your belt already? So, I would say a broker that is able to, speak to you, understand your situation, and then offer products based on that would be, a really good starting point. It sounds obvious, it sounds easy, but you go to a high street bank, you speak to one mortgage advisor, you speak to one poor broker, you're going to get, they might say to you, no, it's not possible, and you're going to get a negative impression, and you might make your investment decision based off that. So, yeah, having a broker that can work, with different types of investors, um, i.e., what your situation is really important. Touching on that as well, a broker that has access to a wide panel of lenders. Again, might seem pretty obvious to a lot of people, but for some people it's not. So not all mortgage brokers are created equal. Some will have a significantly larger range of mortgage products that they can access at different rates, different timeframes, different loan to value levels, i.e., deposit levels. So yeah, again, speaking to multiple brokers or speaking to one good one is going to open up, ultimately more options for you. So they're the two I'd probably just read off quickly. So having a broker who can access a wide range of products, and also having a broker who can, work to your tailored and bespoke situation.
Yeah, I think to be fair, I think they're the main points that I'd covered. Always try and get a broker that's got the whole market, just because you're going to be able to get a better deal. And yeah, like you said, one that's tailored to yourself. I would always ask the broker, look, this is my scenario. Have you dealt with people like this before? And if you did, who did you go to? Who did you approach, and what were the rate? You'll get, if they have dealt with you before, they'll be able to give you a good indication of what you'll be looking at. That will make it very simple to then shop around and speak to other brokers and see what you can have access to and what good rates you can get without fully committing to one straight away. So, yeah, like anything, you want to have a shop around. And I think one as well that you actually get on with, it's like a solicitor. It's like an investment broker or consultant such as ourselves. You want to have one that you can get along with, have a good relationship, or have a good feeling about, because it's quite an important part, and you're going to be having probably a lengthy relationship throughout the process, especially if you're building a portfolio in the long term, want to build
Mm.
a long relationship. Try and get someone that you sort of have that element of trust as well with, that you're
Yeah,
comfortable with.
and
I think that.
just to jump in on that one quickly,
Mm,
you literally took the words out of my mouth, but you kind of related to that. So, what makes a good mortgage broker? Someone that's good at communicating. So, how
mm.
quickly do they respond to you? How clear are they explaining things? Are they doing it over phone, email, or however method you want? WhatsApp. Communication is a massive thing, and it's sometimes in this industry, it's below par. It's just not acceptable, both from agents, solicitors, mortgage brokers. I mean, I won't go on an absolute rant here, but the point is, if you've got a clear, professional mortgage broker who's communicating effectively, it can make a world of difference.
I think
Mm.
actually on that point, very good. A good tester is to see how far and how much they'll do before you even commit to them, because that will also give you a good indication of how much they're willing to work or graft for you. Because I think what you can find with some mortgage brokers, which I've had experience with in the past, is they'll hit one bump in the road with a client and they're like, I really can't be bothered with
I
this.
give up.
Really sorry. I
Yeah.
give up. I can't help you. When it's like, no, you can help them. You just really haven't got the motivation to actually help them out. So again, that's a real good tester when you're looking for a mortgage broker. See what info they'll give you beforehand. See how much they'll help you just off the bat, and like you said, how responsive they are, because that will give you an indication of how the relationship will go. If they're literally like, pay me and then I'll speak to you, that's definitely a sign where you don't want to be dealing with them necessarily. But yeah, I think that's definitely good points you had there. So Nick, why don't you pick the next one? That was mine.
Cool. Well, then floating back to looking at development specifically, and the investment decision process ultimately. One that we get asked is advice about picking a specific apartment or picking a unit within the development. Some people they'll be proactive. They'll go through. They look at the relevant information. I won't say too much here because I'm asking the question, but they'll look at the relevant information and they'll
Yeah.
make a decision. But if you are like advising someone, how would you pick out a decent unit within a development?
Yeah, I think the first factor it comes down to is what they're looking to achieve and their budget, because that will have a factor. So have they got a lower end of the budget? Because again, if they've got a lower end, you're going to be looking at a lower level apartment and tailoring what you pick based on that. So you'll be trying to get the best in that. But ultimately, I think when you're looking at an apartment, it's got to have a mix of sort of a commercial or investment view. So the price matches the floor level and then will effectively get you your returns. Because what we have sometimes is people say, I want the penthouse, which is fine. If you're looking at capital growth and you're thinking future wise resale, that's absolutely brilliant, because penthouse, yes, it's a USP, unique selling point. It's going to rent out all day long, etc., etc. but the yield isn't going to be as strong as maybe one on the middle floor, which is in the exact same position, and going to have a better yield. Because if your focus is yield more so than capital growth, and I would say you're not as fussed about resale in maybe the short to medium term, then that is something you have to consider. But that's one aspect. Mainly, you want to look at the views and the space within the apartment. Obviously, if you've got apartments in a block and they have balconies, can you obtain an apartment with a balcony in the block? Because that will help a bit of outside space. Again, it's good when it comes to renting the property. It's definitely a unique selling point. Can you get a position which is quite limited? So corner unit, for example, facing maybe city centre or waterfront. So getting an aspect which is going to be desirable, because these are the things you want to factor in, not only when renting it out and trying to command as high a rent as possible for your apartment, but also in the future when you want to resell the unit as well. These are factors that are going to come in, because you will find in a block there are limited units that have sort of limited attributes, which you have to then take into consideration. But going up and down the block, usually you can get one within the floor level that will suit your budget. So yeah, I tend to find the actually outlook and the aspect is good. A unique selling point or unique attribute such as a balcony, or even maybe, I don't know, something silly as not all of them have an ensuite to the master. Maybe that's something you'll look for as well. So trying to get something that makes your unit stand out from the rest is definitely something again to consider. I mean, you're good at this. I know, Nick, you're very hot on picking out good units. What would you sort of add to that?
I think you've largely covered off the bits to look for. I think the only thing I'd add in there is about not making silly mistakes. So not getting something that's next to lifts or stairs just
Mm,
because it's cheaper.
yeah.
Not being on the ground floor or the first floor. Not being near a main entrance. Not being. I think I said the lift already, but ultimately, what you're looking for is to avoid anything that's going to disturb the potential tenant. Or the owner occupier if they're buying personally. So yeah, go for those USPs. Get that something that will differentiate your product, ultimately what it is, and then just make sure you're not making any silly mistakes in terms of the immediate vicinity of the apartment.
Just on that, actually, I know. Rule of thumb is usually don't look at ground floor or first floor. I would say I actually don't mind ground floor and first floor. I mean, that is just my opinion. But again, feedback I've actually had from letting agents sometimes is you will get people that don't actually want to go up in a lift or stairs
Definitely.
potentially. So don't. What I would say is don't necessarily rule it out. And again, this is where it comes to maybe speaking to a local agent or the sort of, I don't know, the developer or whoever you're dealing with investment consultant wise, because what you might tend to find is you might have an older demographic in the area which actually may want a lower floor, or you might have on the ground floor they might have their own doors. So don't rule it out completely. Funny enough, I did some research on this quite a few months, and when you actually look into it, each floor actually, all of them have pluses and minuses as well. So yeah, what I would say is don't rule out completely the floor level, but of course there are some attributes which are more desirable, sort of the higher you go as well. Hence why the price factor comes into things, etc., etc.
Yeah, definitely. It's case by case, isn't it? So there's a lot of people do the opposite thing. They assume just like the high floors the best. I only want high floors, but if you're paying an absolute premium for it, it can't be worthwhile. And I used to exactly what you said. Actually, I used to look after a student development in West London, 418 units, and all the time we had people that want to be on the ground floor because they want to nip in and out to smoke. They want to get to the courtyard quickly. They want to go to their car. There's loads of reasons why people would want to be on the lower floors. But yeah,
Mm.
in general though, it is worth saying. I think medium
Yeah,
to upper is normally pretty
yeah,
safe bet.
yeah. You're not wrong there, and the across the board of the industry will tell you that. The next question, then I would say is, are rental guarantees, Nick, too good to be true? As that's something I get a lot of.
Yeah. Um,
Yeah, they are. Or
yeah, that's the response. Yeah,
yeah,
no more. So with regards to rental assurances, it's not a straightforward answer as you would expect. There most of the time in the market as it is today, 9 times out of 10, they're absolutely fine. They're genuine. They're going to come through. In the past, there has been issues. Back when I was working for other companies, the developers might not deliver. They might not deliver as much as they promised originally. They might run into issues. So you have to be aware with regards to rental assurances. You are putting your trust in another firm, whether that's another individual developer, if it's a management company, if it's a large developer, it doesn't matter. You're taking the control away from yourself and you're giving it to someone else. So the things that we advise investors to do is when you're making an investment decision, look at the underpinning performance of the asset. Is it generating at or close to what's being promised by the developer? So if the developer, for whatever reason, disappears, do you still have a strong performing property there? If yes, then you're absolutely fine. It's almost redundant what the rental assurance is. It's just a bonus that you'll have it fixed for a period of time. But if it's the real performance of the property is much or significantly lower, one, the developer is over promising and they're attracting you to try and get you through the door, and two, are they really going to deliver on that for the next 2-3 years? So I would say don't just be put off by a rental assurance, but do your due diligence, make sure the property itself is decent anyway, and then it can just be a nice bonus to have the security of a rental assurance. But just to finish up, just to reiterate on the first point I said, 95% of what you see advertised online these days is genuine and is true. It's not like it used to be where you'd offer 10% for 10 years on a residential property. It was unrealistic. There has been high profile press cases, things the FCA have got involved. It's slowly becoming a lot more rigorous in term and restricted in terms of what you can advertise and what you can offer. So if you see something 6, 7, 8% for 1 to 3 years, it's normally going to be absolutely fine.
Yeah, I think that's spot on. My last sort of two pence to add on to that would be is when you look at standard residential buy to lets, I would say anything over a maximum of 5 years being assured to you would be a red flag for me to do extra due diligence. As Nick touched on, 2 to 3 years is usually what we see. We do see some at 5 years. And in all fairness, we've got one at the moment, which is 5 years, but it's a reputable developer, great track record. So on that side of things, you've
Realistic
got great
return as well.
exactly realistic return. Whereas in anything over the, like you said, the sort of so yield, which looks astronomical, or anything over 5 years, I would definitely be looking into it and doing some due diligence, because I know from investors I've spoken to, they've been drawn into looking at schemes with very, very unrealistic, not only yields, but assurance as well for a very long period of time. And yeah, I just said to them, be very careful, definitely do due diligence. So yeah, that's the one thing I'd add on that.
We could do a podcast on that alone.
Yeah,
But just as a very, very final point, remember with rental assurances, sometimes it can be reflected in the price you're paying at the outset. So make
yeah.
sure you're actually, yes, the return's got to be realistic, but the price you're paying's got to be, fair as well. So, yeah, just another point to consider there.
Which isn't an issue just on that point, because you'll get some people say, well, I don't want to pay more. But what you have to remember, if you are an investor that's maybe a bit nervous and you want peace of mind, it can actually work out okay to pay a bit more um, in comparison to what you pay without rental insurance for that peace of mind. So definitely, if you do think that's a negative, just think about yourself as an investor before completely ruling that out because of it. Because I've had some investors question it before, but when I say that to them, because you're leveraging that against a mortgage as well, you're not paying it cash out your hand. You're leveraging it against a mortgage in most scenarios as well. If you're buying with a mortgage, and you're getting peace of mind for a period of time. So yeah, something to bear in mind on
Yeah,
that side.
it's the same principle as if you pay a bit more to get something complete or close to completion. It's the same,
Yeah,
all to do with your risk profile. But yeah, just to be clear, it doesn't mean just because it's got a rental assurance that it's more expensive or overpriced. It's just on occasions that can be the case. Just got to make sure you're going for the right one. Cool.
yeah.
So yeah, moving on to a bit of about the market, about the current conditions. Would you say prices are, or how are prices reacting at the moment? Are they going up? Are they going down? What are you seeing in the market?
Yes. So, surprising with all the media coverage that the UK property market is getting and has got, well, since coronavirus hit, to be fair, I do get this question a lot. And that's not just from overseas investors, it's actually from UK based investors as well, which is quite surprising. But um, yeah, nonetheless, I shouldn't expect people to know that answer. They're not a nerd like myself who just keeps an eye on the
Property nerd.
property market. Yeah, exactly. But no, in general, that property prices are going up. The property market is strong. The common theme throughout at the moment is supply is very low, demand is very high. You've got the stimulus such as the stamp duty holiday, which has boosted demand as well, and supply has actually gone backwards. So across the board, in general, prices are going up. Now you have to look at this city by city, region by region, but that is the sort of the general consensus, and we are seeing areas such as the northwest performing better. We're seeing Wales as well. I mean, it's not an area that we cover in all fairness, but Wales is up there as well. And surprisingly, I think Belfast is another area that's doing very very well in terms of property price growth. So yeah, you do then need to sort of break them down into location to really sort of pick where is doing well. Obviously, Northwest, we know your main players there, Manchester, Liverpool, etc. But yes, in general, in short, without going off too long on this, yes, prices are actually going up. And a question we usually have follow on from that is, are they going to continue? And realistically, and this isn't just us, this is your sort of big players such as Savills, JLL, etc., that are doing their forecasts and predictions, even sort of Home Track, which is part of Zoopla, etc. They are foreseeing that prices are going to continue for the foreseeable future. Obviously, we don't know, we haven't got a crystal ball, but yes, the way it is, the way the property market is propped up, and the fundamentals that keep prices going up, that will continue. The main factor, which isn't changing anytime soon, is supply and demand, which is one of the main factors we're looking at why the property market will carry on in the position it will be. And again, just I'll finish off on this point. What we sometimes find is Southern/London investors have a different mindset. They will think that the property market, it can't go any further. It's reached its peak. It's overheated, and that's because they're sitting, usually if they're in London, in a market that is experiencing that. They're not looking outside of that area, because when you look north or other areas, prices aren't as high, affordability levels are nowhere near as restricted as they are in the south and London, and that again is one of the reasons why we're going to see growth continue in those areas. Affordability levels in general are a lot more favorable there, and that's not going to reach its peak anytime soon whatsoever.
Yeah, some really, really great insights there. A couple of bits to reiterate with regards to the when you're doing your research and you're looking at your data. Um, if we take the average growth at the moment, is 4.4% in the 12 months to July 21, according to Home Track. So average values across the UK are sitting at just over 4% at 4.4 at the moment. And then what you can do is go down and look at the top 20 cities and how they're performing. But the word of warning I would give, and to reiterate what you said, is yes, we can look at the current market and people want to know what's happening. But really, what I like to do is look at the trends and see what cities are consistently performing well. So places like Belfast or Edinburgh, Cambridge, places like this, they go up and down. They're not that consistent. But I've been monitoring the Home Track report since about 2014, 15. And I can tell you, Liverpool, Manchester, Nottingham, Leeds, they're consistently the high performers. So that's what I say to people: look for long-term patterns, not just short-term media headlines, what's happening this month or what's happened in the past year. Look for those consistent performers. And then within, you might identify a region such as the Northwest. Another thing I always point out to people is, you look at Liverpool, look at the average values for Liverpool. It's 136 grand. And you look at the cities, neighbouring it, Manchester, 193. So, 60 grand more. Nottingham, 175. Leeds, 185. And Liverpool is 136. So Liverpool is growing exceptionally fast. It's got a lot of room to go with regards to growth. The demand is there from the tenant and the investors. It's probably one of the most popular markets in the country at the minute. So, yeah, look at these long term trends and then try and pick out the pockets of where we think the growth is going to be, but then also do what you said and look at the expert forecast. Don't listen to Mr. Smith, who's just opened his agency 10 minutes ago. Savills, JLL, 80,000 employees worldwide. These companies have teams of people researching, producing extremely detailed reports on market analytics. Go by what they're saying, and they are saying, average growth values in the UK over the next 5 years are due to be very, very strong, with the Northwest leading the way at 28%, according to Savills. So, yeah, there's a lot happening in the UK market, and there's a lot going to happen over the next 5 to 10 years as well.
Definitely,
Cool.
it's exciting times. Exciting times. Yeah. So next question. Is this our last one, Nick? I'm trying to
Yep,
think.
finish up on
How
this
many
one.
done?
Yep.
Yeah. Let's finish up on this one. So kind of tied into what we just spoke about there, but more area location focused is a question we have a lot. Is London still a good area to invest? So, Nick, what would you say on that point?
Um, Well, I think London, firstly, is always going to be a good area to invest in. Whether it's the best area to invest in right now is a different story. I think it does depend on people's obviously personal circumstances. If you've got £1 million to invest, you don't have to be as fussy. You can diversify, you can get multiple properties, you can look at commuter belt locations in London, or you can go up to the northwest. You can pick whatever you want. But if you're starting out, you want to grow a portfolio, it might be your first one or two, buy to lets. You want to get as much capital growth as you can for as little money in, then it's almost a no-brainer to invest in the northwest over London. Fundamentally, in the long term, is London a safe bet? Exceptionally safe. It's a global market. Attracts attention from all around the world. It's extremely safe for any risk-averse investors. It's absolutely ideal. The demand versus supply is just a ridiculous ratio. In other words, there's so many people there. The property supply is very, very short, which ultimately underpins the performance of the city. But when you look at investment fundamentals, so investment, regeneration, education institution, employers, transport links, London is very, very hard to beat. But for me, over the next 5 to 10 years, I would still be looking at Liverpool and Manchester, even if I had a good amount of money on me. I'm not sure if you would agree with that, Toby.
Yeah, no, I do agree. And again, it is investor dependent. But yeah, no, I don't think there's actually much I would add on that. Again, if you're looking long term, you're a savvy investor with a very good budget. London is probably always going to be your go to. You'll tend to find London is more so drawn to by overseas investors that don't know the country, so they don't know the areas to invest, because London is obviously going to be like a moth to a flame. It's where they're going to go to. It's
They know
spoken
the
about. They
brand,
know
don't
it.
they? They're familiar
They
with
know
it.
the exactly. It is the capital. So on that side of things, it will always have that demand as well. But don't get me wrong, if I had millions of pounds in the bank, I would definitely not be adverse to looking in London. And in all fairness, if you are looking to buy at London at any point, now is actually not a bad time, because you can get some quite good deals, just because there's a little bit extra supply. But you obviously need a lot of money to do so. And if you're looking pure return on investment in the short to medium term as it stands at the moment, then yes, I would be with you, Nick. I'd be looking northwest and putting my money a little bit sort of more clever, to work in better uses that way.
Cool. And yeah, the other thing I would mention is it's considering the size of London and the scale of the city. It's really important not to just um, tarnish it as one investment strategy, if that makes sense. Maybe tarnish is not the right word, but what I'm trying to say is there's different strategies that you can utilize in London. So buying in, Kensington, Knightsbridge, Mayfair is very different to buying in Staines, Twickenham, Bexley Heath, or
Croydon.
on the outskirts of the commuter belt locations where you can still get good value. You can get in for 300, 350 grand, get a 4.5% net return after your costs. And with the rate that London's expanding, that's going to see exceptional growth in the years to come. So yeah, it's important not to paint it all as one sort of picture, so to speak.
True. True. Well, I think we've done that all, haven't we, Nick?
That's a lot. Cool.
Yeah. Oh, I think that's I think we've waffled on enough. We were going to try and keep that brief, but that clearly wasn't going to happen. So yeah, we can call it a day there. But no, hopefully that's helped sort of any listeners, investors that have maybe had that question come across them, or maybe it's a question they haven't considered before, and now we've given some insight into an answer for that. So yeah, hopefully we've been of bit of some help.
Yeah, perfect. Well, yeah, good to be back on the podcast. We'll try and be a bit more consistent moving forward. Got some exciting topics coming up. So, yeah, look forward to delivering those soon.
Perfect. Well, thanks for joining us, and we'll see you next time. Bye bye.
Cheers, everyone. Bye.